Hi everyone, welcome back to my YouTube channel. This is Raz, and in this video, we will discuss about deductions from the gross estate, particularly the special deductions named such as the family home, the standard deduction, and their benefits received under RA 4917. So if you're ready, let's start. Discussed already some items which are deducted from the gross estate, and those are the ordinary deductions, and in particular we have discussed the losses, indebtedness, the taxes, the transfer for public use, and of course the vanishing deductions. So in this video we will discuss the few remaining items which are still deducted from the gross estate, and they are called the special deductions. As sort of recap, always remember only residents and citizens have the privilege of claiming special deductions. This means that the resident citizens, the resident aliens, and the non-resident citizens can claim these deductions but not the non-resident aliens, okay, except for the standard deduction. In our old National Internal Revenue Code, before the train law, before the year 2018, for example, the standard deduction of 1 million was only available for resident citizens, resident aliens, and non-resident citizens. That was before. But today, we are now in 2021, and the train law is effected, which amends some items of the old National Internal Revenue Code, or the tax code. So today, the RA 10963, or the train law, indicated that non-resident aliens could now enjoy or deduct a standard deduction of 500,000 as a deduction from their gross estate. Meanwhile, the resident citizens, resident aliens, and non-resident citizens could now deduct 5 million pesos as a standard deduction. Before that, before the train law, that was only 1 million pesos. So let us now discuss the standard deduction. Again, there are only three types or three items under special deductions, and the first one is a standard deduction. So in the case of citizen or resident of the Philippines, like resident citizens like you and me, or resident aliens, those foreigners who have already acquired residence in the Philippines, and those non-resident citizens who are Filipinos but living outside of the Philippines, we can now deduct, or any of us can deduct, a 5 million standard deduction from our gross estate. And that is actually according to the Section 28A, subsection 1 of the NARC as amended by the RA 10963. Okay? For citizens, residents, 5 million pesos. But in the case of non-resident aliens, those foreigners who have not acquired residence in the Philippines, they may deduct a standard deduction of 500,000 pesos, provided that they have estates in the Philippines, situated in the Philippines. Because how else would they be taxed if they have no estates or properties in the Philippines? Okay, so actually that was according to Section 86B, subsection 1 of the National Internal Revenue Code as amended. So again, before the train law, before 2018, there is no such thing as this available deduction for non-resident aliens. Only the citizens and residents, and the amount back then was only 1 million pesos. But today, NRAs, non-resident aliens, can now enjoy the 500,000 standard deduction, and this is a standard deduction. Therefore, it's automatic. Whether their estate is less than or more than 500 or 5 million, they can automatically deduct these two amounts. And this standard deduction may be deducted without the need of substantiation. As I have mentioned in our previous videos, that whenever claiming deductions as a charge against your gross income or your gross estate, I always said that you should have substantiated those deductions. But for standard deduction, since this is provided by the law itself, we don't need to substantiate this. We can automatically deduct the entire 5 million if you are a resident or a citizen, or 500,000 if you are a non-resident alien. Okay, I hope that is clear. Now let's go to the second item under special deductions. Again, there are only three. The standard deduction is the first. The second one is the family home. A family home must be the place or residence where the family lives. Okay, so the family home must be the actual residential home of the decedent and his family at the time of his death, as certified by the barangay captain. By the way, when claiming family home, this family home should be located in the Philippines. Okay? It should not be outside of the Philippines. So you can only claim family home as a deduction from your gross estate under special deductions, provided that this property is situated in the Philippines. So the family home at its fair value at the time of death must be declared and included in the gross estate of the decedent before we can claim for family home. The amount deductible for family home must be equivalent to the current fair value of the decedent's family home, but not to exceed 10 million pesos. So this 10 million is actually the maximum amount. So for example, if the family home is valued only at 9 million, then you can only deduct 9 million. Okay? But if the fair value of the family home is, let's say, 12 million, you can only deduct a maximum of 10 million. That's the limit. That's the 10 million maximum threshold for the family home. But there are some situations wherein the family home deductions might get complicated because the family home could be an exclusive property or could also be a conjugal property. So we will have a situation later on comparing these instances, whether the family home is an exclusive or conjugal, or partially exclusive and partially conjugal. So if the family home is a conjugal property, the amount must be divided into two. So let's have an example. So in this example, the family home is classified as an exclusive property of the decedent. Therefore, this family home is titled under his name. So, for example, Juan died leaving his only exclusive property, residential house and lot, to his wife, Maria. The fair value of the property was 8 million pesos. So therefore, in this case, the family home was an exclusive property of Juan, and the fair value was 8 million. This 8 million must be added to Juan's exclusive gross estate. Likewise, this same amount could be deducted as a family home, the entire 8 million. Okay? So in Juan's exclusive gross estate, the property must be included so he can deduct the same. And the maximum amount deductible is only 8 million. Of course, you cannot deduct 9 million because the amount is only 8 million pesos. Okay? Let's have another example. In this case, it's still an exclusive property. So the same example, Juan died leaving his only exclusive property to Maria, but here the fair value of the property was 11 million. So here the 11 million will be added in Juan's exclusive property. But as a deduction, as a family home deduction, Juan can only deduct a maximum amount of 10 million, despite the fact that the fair value of the property was 11 million. Okay, so therefore, if you would imagine our computation, the gross estate includes an amount of 11 million, that is the fair value of the property, but the deduction is only 10 million. There's a taxable excess of 1 million, right? So again, the maximum amount is only 10 million pesos. Now, let's have an assumption that the family home is a communal property, or if you are under conjugal partnership of gains, then let's assume that the family home is a conjugal property. So Juan died leaving their residential house and lot to his wife Maria. The property was part of the community property and is fairly valued at 15 million pesos. Therefore, this property is a communal property and which should be added in the communal property of the decedent Juan. However, when claiming deduction for family home, we will divide this by 2 because there are 2 owners. Technically, there are 2 owners for this property, and that is Juan and Maria, the husband and the wife. So therefore, that's 7.5 and 7.5. So when applying the limit of 10 million, we will apply the limit based on the share only of the decedent. So therefore, it's not the 15 million which we will be going to compare, but only the 7.5 million pesos. So in this case, Juan could deduct a family home as a deduction from his gross estate, a total amount of 7.5 million pesos. Okay, so in Juan's communal gross estate, the property must be included so he can deduct the same, and the maximum amount deductible is only 7.5 million pesos. That is 15 million divided by 2. Okay, so let's have another example. In this example, it's just actually the same, but the property is valued at 21 million pesos. And again, when this is a communal property and when claiming for family home, we will only compare the share of the husband, the decedent, with the 10 million threshold. So 21 million divided by 2, that is 10,500,000. So therefore, in Juan's communal gross estate, the property again must be added, and the maximum deductible amount is only 10 million pesos. Why? Because 21 million pesos divided by 2 is equal to 10,500,000. So therefore, we cannot claim beyond 10 million, so only the maximum amount of 10 million. Okay? So that's if the family home is exclusive or communal or conjugal. Now, what if? What if the family home is partially exclusive and partially communal? Is that possible? Maybe. Okay? So let's have here an example which is partly exclusive and partly communal. Juan was married to Maria since 2005. Juan died leaving a property in their residential house and lot to his wife with the following information given. So, the family home, of course, is a composition of the lot, the land, and the house, right? So, the lot was acquired by Juan on 2006 as a gift from his father. And the fair value of this land today, at the time of his death, is 4.5 million pesos. Therefore, this lot was given to Juan during their marriage. And since they're under the absolute community of property, then this lot is qualified or is classified as an exclusive property of Juan, right? This lot is an exclusive property of Juan because this was received as a gift from his father, and the fair value was 4.5, and it is the same lot where they erected their house. Okay, and here are the data for the construction of the house. It is said that the house was constructed using the conjugal funds, and the construction cost, which was completed in 2007, was 8 million pesos. And the fair value of this house, the house alone, is 10 million pesos. So in this case, the family home is composed of the land and the house. the land where the house was constructed is an exclusive property of Juan, but the house was constructed using the conjugal funds, therefore the house is a conjugal property. And it was completed in 2007 for 8 million pesos, but that's irrelevant because our basis today is the 10 million pesos. So in this case, Juan, in his exclusive gross estate, we will add the 4.5 million. Okay? And in his communal gross estate, we will add the fair value of the house, and that is 10 million pesos. So, when claiming for family home, let's find out how do we account for this. So, we have here the lot was exclusive of Juan, and the fair value of the house was communal. Therefore, the total gross estate, or the amount to be included in the gross estate, is 14,500,000. 4.5 exclusive and 10 million communal. But for family home, the amount deductible is for the lot, that's entirely 4.5, that's entirely exclusive, and for the house, only the share of Juan in the communal property, and that is 10 million. So 10 million divided by 2, so that is 5 million pesos. And we will add together the lot, the fair value of the lot, which is 4.5, and the share of Juan in the fair value of the house, and that is 5 million. So therefore, we have a total amount of 9.5 million. So we will now compare which is lower, the 10 million maximum threshold or this amount. Of course, this amount, the 9.5, is lower. Hence, this amount will be deducted as the family home of Juan under special deductions. Okay, so that is how we account when the property, when the family home is partly exclusive and partly communal. Now, as I have said, there are 3 items for special deductions, and these are standard deductions, and we have mentioned that, in family home. And the final item is the benefits received under RA 4917. So, the Republic Act 4917 is actually a law, an act, which provides that any retirement benefits given by a private employer to their employees upon retirement, upon death, or upon voluntary, resignation will be exempted from the tax, from income tax, or from any taxes actually. So basically, as we have discussed in our previous videos, in our gross estate discussion, any benefits received upon retirement or upon death of the decedent in pursuant to RA 4917 is exempted from any taxes. But you might be asking, if it's exempted, why do we need to deduct? Well, the answer is simple. Though it is exempted from the tax, but we need to add that in the gross estate, okay? Still, we need to add that in the gross estate, at the same time deduct the same from the gross estate as a special deduction. Okay? So, however, as a requisite, despite being exempted from the tax, the amount must be fully included in the gross estate. Also, that same amount must be deducted from the gross estate under special deductions. Okay? So, whatever amount, thousands, hundreds of thousands, or even millions, those are exempted from the tax. So that's it for special deductions, and I hope you learned a lot from this video. As sort of recap, we have discussed in this video the standard deduction, the 5 million and the 500,000, the family home, and the RA 4917. So if you love this video, give me a thumbs up, and if you're new to this channel, please subscribe, click the bell, till you'll be notified whenever I will upload new videos. Thank you so much for watching. Bye!